Good evening, everyone. So this class is the beginner's class. And on this class, we're going to be talking about a whole lot of terminologies, a few terminologies here to help us understand how the market works, right? So when it comes to terminologies, it's quite important to understand them. And the reason is for every business or every industry you're involved in, you have to understand the language, the lingo, as it's said, right? And that's how you know what's going on. That's how you know what you're doing. That's how you know what you are referring to when you are. That's why you know how. That's how you know what you're referring to when you're dealing in the business. When you're doing anything that has to do with trading, so you want to be able to know what you are dealing with. That's why terminologies are very important. You have to understand every terminology so that you can basically use all of that to your advantage while trading. Okay. So this is what we're going to go over here. There are a few terminologies we're going to go over here. This is one of the terminology classes. We're going to have several others, but this during the course of this time, we'll be able to go through a whole lot. Okay, so let's get started. The first thing we're going to talk about today is currency pairs. Now, currencies are traded in pairs. I'm sure we already have learned that in a previous class, that currencies are traded in pairs. And when it comes to currency pairing, think of it like every other thing in the world, right? Any other thing. For anything you acquire, there are two parts to every trade. Once you mention the word trade, there are two parts to it. Okay, there is the buying, there is what you're acquiring, and there is what you're using to acquire what you're acquiring. Okay, so if you're buying this the phone you have in your hand right now, or you want the phone you have in your hand right now, you're going to exchange something else for the phone that you have, right? So everything in that sense is basically a pair, and there is no trade without pairing. So trade by the nature of the word trade, you have to give up one thing to get another thing, right? And also in the financial market is the same situation. So there is no way to trade euro on its own or to trade the dollar on its own. You have to trade it in relation to another currency or another instrument or another asset. Okay. If you want to buy land, for example, there's no way to acquire a land except you pay something for it, dollars or naira, or pounds or euros, whatever currency it is, right? And then when you've done that, then you have the other thing that you have paid for. So everything is a pair in that sense. So that's the way it is here. Even though you are dealing with currencies, during the course of purchasing a currency, just think about making a trip, for example, and you're trying to, take a trip from where you have your current location to a different location, right? Now, when you take your local currency to the bureau de change or, to the exchangers, basically you take your local currency to the exchangers and they exchange for a different currency. What you're actually doing is you are purchasing that currency. Let's say you're going to the United States, for example, right? You come and you purchase the dollar. But remember, if you're spending naira, for example, or rand, for example, to purchase naira dollars, remember that rand is a currency or naira is a currency, but the United States dollars is also a currency. But during the course of that trade, you're not treating everything like a currency. You're treating one more like a commodity and the other one like a currency. So a trade will always happen like that all the time. So there are always two parts to a trade. That's where this idea of, pairing came about. I wanted us to understand how that came about, okay? Now let's look at this. So you have a currency pair like this. You have the currency on the left-hand side and the currency on the right-hand side. And mind you guys, this is not just for currency pairs, this is for all assets. Even when there are some assets that may be done in such a way, they may be the ticker for them or the symbol for them may be done in such a way that it doesn't seem to include the dollar. For example, NAS 100. NAS 100 is an index, right? So for NAS 100, you may not see the dollar directly represented in the pair as it is expressed. As it is expressed, you may not see the dollar directly represented in that pair. But that doesn't mean that you can trade the NASDAQ by itself. You can't trade the NASDAQ by itself. You're always pairing it with the dollar. Okay, you're always pairing the NASDAQ to the dollar for you to be able to make a trade. So that's the way it is, not just for currencies only, but across board, across all instruments, across all assets, basically. Okay, so when you look at this now, you notice something. You have a currency on the left, you have a currency on the right, right? Now, the currency on the left is what we call the base currency. The base currency. While the currency on the right is what we call the quote currency. Now, the base currency is called that because it is the basis of the trade, the basis of the transaction. Okay, so think about you trading Euro USD. What is the idea behind? And remember, for every trade, you're either buying or selling, right? You're either buying or selling. Now, if you want to buy this currency pair, remember you can't buy one or sell one. It has to be a pair. Okay. Now, if you're buying this pair, with considering the euro, with your mind on the euro. So if you go to a chart, for example, a Euro USD chart, and you see the chart rallying, you see price rising, that is actually representing the strength of the euro. That chart is showing you that the euro is actually strong. That's the reason why you're seeing that currency rising. So when Euro USD currency is appreciating, that is actually representing the strength of the euro. So if you want to buy a currency, you've done your analysis and you want to make a buy on Euro USD, you are buying it because you expect the euro to be strong. Okay, let me say that again. When you are buying a currency like the Euro USD, you are buying that because you expect the euro to be strong against the USD. Now, the USD and the euro have this inverse relationship. They have inverse relationship, like a tug of war kind of relationship, which means that when one is rising, the other one has to sell. When one is strong, the other one has to be weak. If both of them are strong at the same time, at the same pace, there is no way that you can trade that currency. We're always taking advantage of, price difference. We're always taking advantage of disparity in strength and weakness. Okay, so if euro is very strong and the dollar is very strong, there will be no movement, which means that you cannot trade. There will be no volatility, and when there's no volatility, you can't make money from that. It's like you buying something for $10 or $50 to resell it, but the price remains $50. What happens? You cannot make money from that, right? So the price cannot remain the same, and the only way for you to ensure that the price doesn't remain the same is to play with a weak and a strong a weak and a strong currency. So if the euro is strong, the USD has to be weak against the euro for price to move. But when you're buying this pair, you are thinking of the euro. When you are selling this pair, you are thinking of the euro. You're buying it because you expect the euro to be stronger than the dollar. You are selling this currency pair because you expect the euro to be weaker than the USD, right? So that's the idea behind the base currency. This is what's happening behind the scenes. Usually when you're looking at the market, you're trading and trying to trade, you don't see this very evidently, but this is what's going on behind the scenes. That's what you're actually doing. When you are seeing price rising, that is the euro rising in Euro USD. When you see price selling, that is the euro selling against the USD. So when the euro is rising, that means at that time the euro is weaker than the USD. When you see the currency pair rising, that means at that time the euro is stronger than the USD. When you see the currency pair, this euro currency pair selling, coming down, it tells you that at that time the euro is weaker than the USD, because they always have that inverse relationship. When one is rising, the other one has to be weak. When one is strong, the other one has to be weak, right? So that's the idea behind the base and the quote currency. Another thing here to recognize about the quote base and quote currency is this. Now look at this. You have this is a currency pair, this is another currency pair, GBP, USD, and then you notice that GBP USD has a price attached to it. Now, every currency pair or every asset or every instrument has a price attached to it per time, right? Per time. But that is always changing. That's always, price is always fluctuating. For all instruments, price is constantly fluctuating. And that fluctuation in price is how we make money in the market. If there is no fluctuation in price, like I said before, nothing moves. And if nothing moves, money doesn't flow. If nothing is moving, money doesn't flow. So if you, like I said, if you're in a physical trade of a particular commodity, you buy it for $50, and then the price has to be higher than $50 for you to sell it. If the price in the marketplace, so you went somewhere to source this product for $50 per piece, and then you come back to where you're going to sell it, and it happens to be $50 also per piece. How do you sell? You don't sell. So what happens? There is no flow of money. There's no flow of money. So that's the same thing that happens here. The volatility and the constant fluctuation we see in prices of instruments, is how we make money in the market. So it's very important for us to continue to see that flow of fluctuation. And when that fluctuation closes, just like during the course of a weekend, when there is no fluctuation in price anymore, what happens? We all fold our hands and leave the market because you can't make money from that setting, right? Market is closed. So that's the way it is here. So understand that a price pair, a currency pair, has a price attached to it at every moment in time. So go to your chart, look for any instrument. Look for any instrument at all. You will see that it has a current market price. It has a current market price. Price at this moment is there right now. Okay? Now, so that's what we call a price quote. We call it a price. We call it the price of the pair, or we call it the quote price, or we call it the quote. Whichever one you want to use, everything is right, right? So very important, the price of the pair. Now, something about the quote currency, like I was saying earlier, is that this quote currency is used to quote the price of the pair. So GBP USD has a price of 1.21228. That's the current market price of GBP USD, according to this, from this document, right? Now, this 1.21228 is expressed with respect to the quote currency. That's what it means. That's the reason why it's called the quote currency. Though it's also called another name. It's also called the counter currency. So it's called quote or counter currency. I think that's somewhere. So it's either called a quote currency or it's called a counter currency. So in terms of counter currency, it is called a counter currency because it counters the base, which means that it does opposite of what the base does. But in terms of quote, quote is a term that is used because of the importance of the second currency in the pair. So look at this now, GBP USD equals 1.21228. It means that it will cost 1.21228 USD to buy 1 pound. So this price is expressed with respect to the USD, the quote currency. That's where the idea of quote came in. This currency price, this is a currency pair, this is the price of the pair. This price is quoted with respect to the quote currency. So this number right now is in dollars. That's what it means. 1.21228 is in dollars. So if you have USD JPY, it means that the price you are seeing there is going to be expressed in JPY. The price, the current market price of that instrument is expressed in terms of the quote currency. So if you have USD CAD, the price that follows that instrument is going to be expressed in CAD. That's exactly what we're saying. So if you have USD ZAR, USD ZAR, the price you see will be expressed with respect to the South African rand, which is the ZAR. Same thing goes for the Naira. If you have USD NGN, the price that follows is going to be expressed in respect to the NGN, which is Nigerian Naira. I hope we understand that. Okay. The next terminology we're going to be considering here is what we call the pips and points. Now, this is quite important because every time price makes a move of any amount, every time price makes a move of any amount from one point to another, that difference in price is expressed in a certain unit, it's expressed in certain points. That's what we are talking about here. So pips is price interest points. It's also known as percentage in points. So pips is something you hear a lot about, with traders. So how many pips was that trade? How many pips was that trade? Or how many points did that trade move for? That's what you're always going to see that. When you see price made a huge move, oh, wow, how many pips was that? How many points was that? You're always trying to know when price made this particular move or this particular move, how much movement is that? How much movement is that? And that movement is measured in either points. Pips, like I said, it means price interest points or percentage in points. Is used to express a change in price. When price moves from one place to another, that change is expressed in pips. Okay, so now let's look at this. When price let's say price moves from 1.21228 to 1.21528. So if price moves from 1.21228 to 1.21528, that difference there is captured, is measured in points. That's what we're talking about here. That difference is measured in points. Okay. And then when it comes to, let's say in that case, you are there with 300 points. Price move from 1.21228 and it goes to 1.21528. That difference difference about 300 points. Now, how is it 300 points? Whenever you want to check the difference between price points, price move from point A to point B, and you want to check the difference between difference between point A and point B, that difference usually, when you do that, when you subtract 1 point from another, just simple. You're subtracting point A from point B. You're subtracting the entry from the target. So price move from point A, that's the entry, to the target is to point B, that's the target. So you subtract A from B. You subtract entry from targets. But when you do that, make sure you are ignoring the decimal point. Ignore is the word. That's when you get an accurate measurement. You are getting an accurate number. But you can do this on MetaTrader 4, MetaTrader 5 without having to manually do it yourself. You can just take a ruler on the screen, tap it from one point and drag it up or drag it down. You can always catch the number of points or pips that's there. But that's what pips and points is all about here. You are always trying to know when price moves from point A, it's more like you are in a room, for example, and you're trying to measure the distance from one point to another. Distance from one point to another. That distance is usually measured in meters or in centimeters or in feet or whatever unit you want to use. But one unique thing is that one is convertible to the other as well. So you are like, oh, this is 10 meters. 10 meters is also 1,000 centimeters. 10 meters is also 1,000 centimeters. 1 meter is also 100 centimeters. It's the same thing. So one person can use centimeters, the other one can use meters, and they are still talking about the same thing. So that is the disparity actually between pips and points. Pips and points are basically the same, but this is the relationship they have. Just like 1 meter equals 100 centimeters. That is how 100 or 10 pips equals 10 points equals 1 pip. Say that again. Just like 1 meter equals 100 centimeters, or just like 100 centimeters equals 1 meter in measuring distance, 10 points in the market, 10 points move in the market equals 1 pip. 100 points move in the market equals 10 pips. 1,000 pip move in the market equals 100 pips. So the easy way to do this is that if you have 100 pips, if you have 1,000 points, you take your ruler on your chart and then you drag from point A to point B, and you see it's giving you 1,000 points. When it's giving you 1,000 points, or you decide to subtract the entry from the exit, right, on the chart, let's say it gives you 1,000 points. In pips, what would that be? In pips, that would be 100. In pips, that would be 100 pips. That's what we're saying. So pips and points have a relationship. They work together. They are one and the same thing, just that one is a multiple of the other one. They are one and the same thing. Pips and points are one and the same thing, but one is a multiple of the other one. So the next thing we're going to talk about here is spread. So spread is a very key word, a key term, the key terminology as well. The key terminology as well. And you want to pay attention to this because this is how much this is what you pay whenever you enter a trade. Whenever you enter a trade, this is what you pay. So as a trader, you are going to observe what your spread is. What is my spread? Okay. In Vantage markets, for example, we pride ourselves as one of the brokers with the tightest spreads across instruments. So if you don't have an account, if you're watching this if you're watching this anywhere, you don't have an account yet, just go below, click on the link below and create an account and begin to trade on Vantage markets. Okay. So if you have any inquiries you'd like to make, please just drop a message for us and we'll respond back to you. We're very glad to do that. Okay. So yeah, basically you want to observe your spread. What is your spread? What your spread is. Because this is what you pay every time you enter a trade. The higher your spread is, the more you are paying, which means the less profit you're taking from a profitable trade. The less profit you're taking from the profitable trade. Okay. So an example is if you make $10 on a trade, or you make $20 on a trade, and your spread is 5 points or 50 points. Okay. Let me use simple numbers that'll be easy to understand. Now, if you make $20 on a trade, if you make $20 on a trade, and your spread is 10 points, and 1 point is equals $1, what you have done is you made $20 profit, but you're actually walking away with only $10. Why? Because the broker is charging you a whole lot, literally 50% of what you made on that trade. You are paying it out as spread. But imagine that you made $20 on a trade, but the broker is only charging you 2 points, meaning $2. This is an illustration, guys. Doesn't mean 2 points equals $2. It's just an illustration. Okay. So, but the spreads are actually very tight. So you can see that in those two situations, these two traders made $20 each, but one went home with $18. One banked $18, the other one banked only $10. Why? Because they got charged a lot. What they got charged was so heavy, it took out a lot of their profit. So the higher your spread, the higher your spread, the less you are going to go home with when you make a profitable trade. So like I said, that's why for us, we are very particular about giving you the best trade, the best spreads in the market, right? So now when you pick an instrument, let's look at this instrument here. Let's look at a couple of instruments here. So here you see that we have Euro USD, we have GBP USD, we have USD JPY, you have USD CAD, you have AUD USD. All of these are different currency pairs. Now you'll notice something about them. You notice something about them. They have two prices attached to them. Look to the right, you see that they have two prices attached to them. Okay, two prices attached to them. Now, those two prices are what we refer to as the bid and the ask price. The bid price is the price on the left of these instruments. Now, the bid price is the price on the left, while the ask price is the price on the right. The bid price is also known as the sell price. The bid price is also known as the price at which you are selling. So if you go to these instruments now and you place a buy, you click on USD JPY, for example, and you click new order, or you click on trade and you're looking to place a trade, you will see a sell price and a buy price. That's what is represented here right now. The difference between them is what we call the spread. Difference between them is what we call spread. And that's what I was talking about. That's what I was talking about earlier. The difference between the bid and the ask is what we call the spread. The difference between the buy and the sell and the buy. The bid is the sell, the ask is the buy. The difference between them is what we call the spread. Okay. Now, when you look below, let's take GBP USD, for example, right here. Take GBP USD, for example. You will look below the USD, GBP USD, you see 17.44 and all of that. That is time. That is server time. Okay, that's server time. Server time for MT4, MT5 is always 2 hours ahead of GMT. GMT plus 1. So it's GMT plus 3. Server time is GMT plus 3. Okay. Now look at this. You see that 1.5 that's attached to it? That is the difference between the bid price and the ask price. The difference between the bid and the ask is this 115 here. This 15 is 15 points. 15 points is actually 1.5 pips. Like we said before, the relationship between pips and points. So if you have 10 points, that is 1 pip. If you have 1,000 points, that is 100 pips. If you have 100 points, that is 10 pips. Okay. Now you have 15 points, that is 1.5 pips. And that is very low spread to trade GBP USD. When you trade GBP USD with this kind of spread, you make even more money. And then guess what? In Vantage Market, we have even other account types. This is what we call the standard accounts. We have other account types that have even lower spreads from zero spread. From zero spread. Spreads are not fixed, by the way. Spreads always fluctuate. So many times we have certain accounts that if you decide to trade on those accounts, you can get as low as zero spread. But we do charge you a little commission though. Very tiny. Very, very, very tiny. The tiniest we get amongst our competitors. Okay. So very important, guys. It's important that you're trading with a platform, a broker that has the lowest possible spread. And that helps you make more money. That helps you keep more of the money that you make, which is very, very important, right? So these are some of the terminologies we're going over today. This is the first terminologies class. We're going to be having future terminology classes too. There are a couple of other terminologies we'd like to break down for you, but we want to take it piece by piece so that you understand them and go deep in them. Okay? So if you have any questions and you're something you're not clear about, so you can ask the questions. And you can always ask your questions by putting a comment on the video anywhere you see our video. Just put a comment there. We'll always be available to respond to you and to clarify whatever you need clarity with. Okay, that's very important to us. So if you have any questions, please go ahead and make a comment, and then I will respond to you quickly. So I'll give 3 minutes for that. In 3 minutes, there's no question. I'll take it that we are really good with this. Questions?
We can't drop chat.
You
Maybe.
can't. Oh, sorry. Let me see. Uh, let me see. Yes, please. Now you can drop chats. You can drop chat, please. Can you? Okay. Valentine, I should go back to the beginning. Let me see what you're talking about. We started from here, currency pairs. And we said that when you have a currency pair like this, we talked about why currencies are paired. We said everything in our world today is a pair. Okay. And then we said that when you see a currency pair like this, you have the base currency and the quote currency. Right. This class is being recorded, by the way. You'll be able to go back. We talked a lot about this, so you'll be able to go over it and understand it very well. Any other questions? Yeah, so instruments with very large spreads. Basically, instruments, oh, I should have added something here. Instruments that we consider exotic pairs. Exotic means that it's always a pairing of a major currency and an exotic currency, like USD ROUB. ROUB is Russian ruble. USD ROUB or USD ZAR, USD South African rand. Those are what we call exotic pairs. Now, when you look at the pairing of instruments like volatility index on Vantage markets, or you look at um, the you look at the pricing, the spreads on volatility index, you look at the spreads on cryptocurrency, you might think the number is big, but it's not. It's actually very tiny. It's just it's the way the numbers are arranged. It is the pricing structure that makes it look. You might see something like 160. And oh, is that not big? No. For that particular instrument, is actually very, very tiny. Okay. So if you're asking for instruments that have high spreads, I will tell you exotic pairs, exotic currency pairs. And by exotic currency pair, for you, the way you know them is just look at the currency that has been as a currency of a minor country paired with that of a major country, like USD ROUB, like I just said. USD, USD MXN. MXN is Mexican peso. All right. That is that. Then USD Chinese yuan, CYN, USD CYN. That's USD Chinese yuan. That is going to have a high spread as well. Generally, exotic pairs have a high spread because there's usually very compressed volume. The volume that's flowing through those particular instruments are very tiny compared to the global market. So the spreads are wider. It's more like you're trying to sell only a few products. Let's say you do a business where you sell only a small number of products in a month. You want to be able to make as much profit from those from the transactions you do, from the sales that you make. But imagine someone who makes sales of 1 million units of whatever he's selling on a daily basis and decide to take very tiny profits or tiny margins and still make good money because he's doing huge volumes. So because there's huge volume in Euro USD, there's huge volume in GBP USD, USD JPY, all of these have huge volumes going through them by reason of the fact that they are major currency pairs. The spreads for them are low. Spread is the transaction cost, basically. That's what spread is. Your spread is your transaction cost. So if because of the volume that's going through, the buy and sell volume that goes through in the course of the day, this spread, the transaction cost is tiny, is reduced because of that. But for those exotic pairs, the transaction volume is wide because there is fewer, less, relatively smaller volume going through those currency pairs. That's the reason why. And exotic pairs, you can find them. There are so many. You will even see, just the way I illustrated to you now, the spread, where the spread is. Go there, you will see. It's very large. Some of them, you can't even be profitable trading them. No matter how much profit you make, you can't be profitable. How are commissions calculated and why should one choose a broker account type that gives zero spread and charges commission? So usually, when you say commissions are calculated, what do you mean commissions? Clarify that, please. So when you are picking it's not about broker. Like I said, now Vantage Markets has different types of accounts. Okay? It's actually dependent on the preference of you as the trader. On depends on your preference as a trader. Now, we have two major types of accounts. We have several account types, right? But they are majorly categorized into two because you either have an STP account or an ECN account. Okay. Now, an ECN, a raw ECN account is a zero spread account, which means that it is zero most of the time. Then we charge you a tiny commission. Now, that commission is taken out of your P&L, which is your profit and loss. You will see it in your account that you made $100 profit and let's say $5 was deducted or $2 was deducted. You will see it there in your P&L, right? And then once you deduct it, you see that your $100 becomes $98 or something is there. Everything is there once you have closed your trades. Now, on the other hand, there is the STP account. The STP accounts, the profit, the commission, which is the spread, is not taken out of your account. It's taken out of your trade. So the way that works is that when you enter a trade on a spread account, which is an STP account, when you enter a buy or a sell trade, your trade goes into negative first. That is the broker taking that spread that you're seeing there, 1.5. The broker takes your spread first. Then once you enter into profit, everything is profit for you. So if you close your trade at the $100, it will be $100 in your account. Nobody is going to touch it. Nothing will be deducted. So there are people who are allergic to, many traders who are allergic to seeing deductions on their account. In that case, just stick with an STP account. So the way STP works is that once you standard account, once you enter your trade and the trade goes in your favor, you close your trade, you don't even realize that you are paid charge. It's more like it's factored into the trade itself. And then when you finish, you have your entire profit directly in your account the way you expected it to be. But for ACN, it's a little bit different. You see that charge taken out of your P&L, right? So that's just the difference. And this is up to you now, which one you would like. For me, if you ask me, I trade mostly STP accounts. ECN accounts are great to trade as well, but I mostly trade STP accounts because I like the fact that I place a trade and the spread gets factored into my trade. And by the time I close my profit, the whole profit that I see is right in my bank account. But it depends on you. If you want a zero spread, you want spreads to be very tight, but you don't mind a little tiny commission, fantastic. So that's how you choose which account you decide that you want to go with. Whichever one you want to go with, great. It's actually a question of preference. We understand that? Okay. Okay. All right. We'll end the class now. Like I said, this recording is going to be made available to be on YouTube, and then the link will be shared for us to go over again. This is terminology class 1. We're going to continue with in future classes. Thank you. I'll see you guys on the next one.